Guide to small account growth with in-out spreads. I am Don Kaufman. I'll be with you here for, just about 4 hours. I think that's pretty much where we're going to come in today. Today's course, a full 4-hour tour of not only in-out spreads, but allocation as well. With that, risk disclosure, we're not financial advisors nor a broker-dealer. I always mention that because I did spend 15 years in the brokerage world. Copyright disclaimer, it's mine, it's not yours. You have to have the written express consent from the National Football League. Listen, after today, if you ever need to get a hold of us, okay, here we are. Support@theotrade.com. Again, support@theotrade.com. We are located right here in Scottsdale, Arizona. A little bit about me. So I started trading in the late 90s, pretty much 3 weeks outside of college. I come from a family that traded in Chicago. It was, again, as I said, 3 weeks out of college. About 2 years thereafter, I was invited into a startup brokerage firm. That brokerage firm became Thinkorswim. We took the company public in 2007. We were acquired by TD Ameritrade in 2009. I went on to run education for both Thinkorswim and eventually TD Ameritrade for the better part of almost 15 years before exiting in 2015 and launching TheoTrades. It's a little bit of my background. All right. Today, we have some highly detailed learning objectives. First thing, you got to learn to implement, the spread and the spread criteria, execution of the strategy. Now, these are not necessarily in order, but hey, listen, you've come here today to learn a little bit about in-out spreads, of course, and the detailed criteria, but more importantly, how to take this, from, we'll call this the classroom, to definitively executing the strategy. One of the things that's most important to me is that this is not just, again, kind of textbook we go through and you're kind of left on your own. Absolutely not. We're actually going to show implementation of the strategy, execution of the strategy. What does that mean? It means sending it. It means pulling the trigger. Number 2 over here is understanding probabilities in your trading. We're going to discuss a little bit about probability of touch, overcoming time decay in option trades, consistency in trading, which is, of course, one of the critical parts of the in-out spread. We will discuss a little bit about contrarian setup, trading binary events. And, of course, we have allocation and account appreciation on here as well. Now, to kind of kick this off, all right, I start, a huge amount of the courses that we do here, at TheoTrade with this kind of mantra, if you will. People always ask, what does TheoTrade even mean? Well, now you know. It means theory, trade, logic. That's what it actually stands for. That's what TheoTrade means. It means theory, trade, logic. The first thing you got to learn, in this business is that probabilities, they really are law in these markets. And that one trade, good or bad, it does not and cannot define you in this business. And the reason I'm throwing this out to you, when I say probabilities are law in the markets and one trade can't define you, what it comes down to is about number of occurrences. So trading goes beyond. It's not about one trade. When you talk to individuals about their trading, like, oh yeah, man, my account was going great until that one trade. Everyone that's in this room, if you've had some experience. Now, listen, not everybody that's joining us this morning, has live trading experience. Some of you are going to be absolute newbies. And if you think about that, that's actually not a bad thing. By the way, I'm like, oh, he's brand new to trading. He's never pulled the trigger. Good, because you're going to listen to this and probably not make some of the mistakes that many of the people in this room have made. But almost everyone that's had some trade experience, you could pretty much point out one or two individual trades that hurt badly. And that's what I talk about when, probabilities are law in the markets. that one bad position should never define you. And I'm going to talk about how to overcome specifically that. Yeah? Anybody? No, nobody's ever had that before. One stock goes down big, absolutely kills you. It's good stuff. Listen, trading, it goes beyond that one trade or one idea. Thousands of occurrences, having the right logic over time. And it's incredibly important that we understand that coming in, that, not any one trade, is going to define us in this business. Now, start from the beginning. So let's just revisit a few of the basic concepts in options, right? It's important because we're about to embark on a little bit of a journey into the in-out spread. And we have to understand, first of all, why we're even going to use this in-out spread in lieu of some of the other available tactics in this business. So we can buy a call or buy a put to take directional bias. But what are some of the risks you encounter? What's going to happen when you go out there and just buy a call or buy a put, right? Instead of using, what we're going to get into, which is an in-out spread. So, we'll start from the beginning over here. The risks of single options. Let's assume we just buy a 30-day at-the-money call option in a stock, right? We're going to review the risks. So what I'm actually suggesting in this particular example, and I'm going to take you through example after example after example in today's session, but, you just go out there, okay, and we'll say that we have a stock, and the stock could be trading literally at $100, okay, and an at-the-money call would be the 100 call, and that 100 call, let's say it's trading for $3. $3. What's the risk of this? Okay, what's the risk? First of all, right, if you buy a 100 call, the 100 call gives you the right to buy the stock at 100. What'd you pay for it? $3. That way, you're going to need the stock to get to at least 103 just to be able to do what? All right, that would be your BEP. That is the break-even point. All right, now we're having some fun. So you go out, you buy a 100 call. Okay, forget all of this for a second. Let's review some of the risks of this particular position. First one that comes to mind, time decay. Buying an individual option immediately, it puts you on the clock, right? Okay, so we're talking about this 100 call, and this 100 call, all right, when I say it puts you on the clock, every single day that passes, the dwindling of your options premium, so you've seen your $3 and nothing happens, and like, oh, I'm sinking, and then it's worth like $2.80. You're like, that's not too bad. And then the next day you hop on the screen and it's worth $2. You're like, it's not even worth selling anymore. And then all of a sudden it's worth 20 cents, and you're like, that's it, I'm done. And it's, again, it happens to a lot of new people. But again, review a little bit about decay. And we're just going to quickly kind of gloss over some of this because I want you to understand where we're kind of coming from to get you to where you need to be in terms of the spread. So options decay at what's termed the square root of time. Listen, all that means is the closer you get to expiration, the faster the burn rate happens, right? That's it. That's all I need on that slide to you to understand. The closer you come to expiration, the faster we're going to burn. So this is also what I term the power of decay. If you have an option, for 1 month, right? What is an option for 2 months then trading for? So an option for 1 month is trading for $1. An option for 2 months is trading for, when I say the square root of time, it's 1 times the square root of 2, which is $1.41. Like, oh, that's interesting. Okay, it is interesting because if an option for a month, what I wanted you to know is that an option for a month is trading for $1, it does not mean that an option for 2 months is trading for $2. Okay, options literally decay at what we term, again, that square root of time. So what this often leads people to do, all right, is to go out then and they buy options further out in time, which is also going to have, okay, substantial risk associated with it. So they first go out and they buy options for about a month and they learn, oh, the decay is too fast. But then they buy options further out in time. Now there's not as much decay. No, now you have to deal with other issues. Like the options further out in time, they don't move in price nearly as fast. Again, in this options world, there are trade-offs for everything you're going to do. Everything you're going to do, there's going to be a trade-off. You know, if you buy this option, it decays too fast. You buy this option, it decays slowly. But if you buy this option, it decays slowly, you can't make as much money on it. Okay, what we do, and the reason I take you through this stuff is what we do is we literally spend years cranking and fine-tuning criteria to give you definitively like, what's the sweet spot? Like, hey, where should I be? Should I be at 1 month? Should I be at 2 months? Should I be at 3 months? Okay. That's the important point of me going through this. Now, theta. Theta is the whittling down of an options value. It's just the easiest way to say it. Oh, my theta burns when I'm long options. Okay. When you buy options, you're burning decay. What is your theta burn rate? Are you positive or negative theta? That's a good question, right? So it's a good question to kind of start with. There are some trading applications that offer something called theta. Theta is how much you are collecting or how much you are paying for every day that passes strictly from time value. In this particular screenshot, okay, right there, I am what they term positive 231 theta. That means all things being equal, this, whatever it is, doesn't matter what it is, okay? Whatever the options that I'm trading here, okay? I'm collecting $231 today. Now, theta, and the reason I'm bringing it up, and this is not going to be a highly detailed lesson on theta and gamma and vega today. Push it aside. But the reason I'm bringing it up, I cannot tell you over the years how many times that I've looked at others' brokerage accounts, right? So when working at Thinkorswim or TD Ameritrade, right, somebody sends me an email, okay, and in that email it says, hey, I really need help with a position. So the first thing we do is we go into their account, okay? And they said, well, I'm hemorrhaging money. I said, well, this it only took me about 1 second to figure out. I go, oh, you're hemorrhaging money? They'd have a $10,000 account, and their $10,000 account would be negative $231 of theta a day. And I go, oh, we found your problem. You're losing, okay, what, about 2% of your account a day in theta. And by the way, that theta accelerates, right, the closer you come to expiration. So welcome to trading. And it was easy. It was always easy. You just look at their theta, you'd be like, hey, that's why you're getting hammered over there. By the way, this is not on a per contract basis. It's net. It's dollars and cents. Literally, it's $231. This is what we call an aggregated or accumulated theta, which effectively adds all the option contracts together in your entire portfolio to one lump sum. Pretty sweet, huh? It's kind of a cool way of looking at it. So I would take one glance at somebody's theta and be like, yeah, you're hemorrhaging money because of theta. In this case, this is good. This is, $231. I am not necessarily, okay, dictating today whether you should be positive or negative theta. What I'm actually talking about today, the in-out spread is going to offset most of your theta. You'll see that here. Negative theta in you. Negative theta, again, it implies that every day that passes, you're paying to hold a position. So if the underlying does not make, okay, the intended move, you're going to burn capital waiting for the move to take place, right? That's one of the problems is when you're burning theta, you just go out and buy a call. So as I was elaborating upon a little bit earlier, we had this 100 call, and that 100 call cost us $3. If the stock stays at 100, okay, every day it does not move your intended direction, buying a call is what? It's bullish. You hope that stock goes up. But if the stock stays flat, you're burning part of the $3. If the stock goes down, okay, you're actually hemorrhaging part of the $3. The only way you can make money is if that stock goes up, and the stock has to get, okay, to at least 103 just to get your $3 back. You got to think about that also from a probability standpoint. Next, volatility exposure. See, what I try to expose you to is this, okay? The things that hurt retail clientele. Retail clients. That's, by the way, that's not a dirty or a negative term, okay? You're a retail client. I'm a retail client. All of us pretty much in this room are retail clients. Actually, we have a few institutional traders that are here at TheoTrade, but that's okay, okay? We will not hold it against them. But with retail clientele, the things that typically hurt, okay, people trading options are time decay and volatility exposure. So the entire logic, if you will, of the in-out spread is to initially negate both theta and volatility exposure, both time decay and volatility like exposure in here. So volatility exposure of long options, volatility exposure, if volatility goes down and you're long an option, your option will depreciate in value, okay, by an amount equal to Vega. As I said, I don't want to get detailed into Vega. Vega is an option sensitivity to changes in implied volatility. I just love that. Vega is a very sensitive individual, okay? He gets very upset very easily. Now, I mean, basically, what is sensitivity to Vega? Are you sensitive to Vega? If you buy a call option and the stock goes up, right? Let me think about this for a second because it's a little counterintuitive, but here, we're doing, again, our 100 call, okay? And the 100 call is trading for $3. But the crazy thing, when stocks go up, so let's say that this stock, which is currently trading at 100, the stock goes I mean, we could do the little mountain climber thing. That's when Price is Right. I think I learned to count from Bob Barker. Anyway, as the stock goes up, the stock goes, let's say, skyrocketing, right, to 105. But as the stock goes up, its volatility, right, actually goes down. As the volatility goes down, it's actually sucking some of the premium out of your $3. You're like, that's not fair. It's not fair. You kind of feel like it's what they call getting crushed, volatility crushed. That's exactly what it's termed. So as the stock goes up, volatility often goes down. Why? Because there's not as much risk. Now, again, we got to get you away from this. We got to get to offsetting your risks. It's essential that we offset your risks in order to make your trades less susceptible, okay, and really impenetrable, if you will, to time decay and volatility risks. Keep this in mind as we move forward to in-out spreads, all right? That initial section there, it's about risk mitigation. It's about offsetting the risks. All right, I'm going to leave this over there for the time being. All right, probability review. So we set you up talking a little bit about theta. Okay, we set you up now talking a little bit about probability. And then these factors are going to come into play. All right, there's a method to the madness. These factors are going to come into play when we start to actually build our spread. So we're just setting you up for a little background knowledge before we actually get into, tactically speaking, how to place these trades. Probability review. Before diving head-on into spreads and criteria, we got to give you a bit of a comprehensive understanding of probabilities in trading. The preceding examples transcend an individual trading strategy, and they can actually be used in all aspects of your trading. So I'm pretty adamant about this, what's termed probability of expiring. Okay, so the probability of expiring, first, the probability a stock or index will be above a certain point at an expiration date, yada, yada, yada. The probability numbers themselves are based on formulas, okay, that use current stock price, okay, the target or strike price, interest rates, days to expiration, and volatility. And by the way, I love this. I love just the marquee definitions. Probability of expiring is not defined as making or losing money, but it's the chance of each unique option falling in the money, okay, or out of the money by 1 penny or more on the corresponding expiration date. Listen, I have to go through the marquee definitions. Do you want to know why? Because we have engineers in the room. That's why. Because the engineers have driven me to the point where I actually have to put down the definition. Okay? Otherwise, they're going to email me and be like, is that really mathematically what it means? No, this is what it mathematically means. All right. Now, for those of you that do not live in the engineering underworld, this is what I call buy me a low probability. Okay? You'll understand what a black swan and the Bears logo means here momentarily when you buy an at-the-money option. Okay? What is effectively your probability of making 1 penny or more? By the way, this is it's kind of a fun story. I did a class a couple of years back, and that class included, okay, can't make this crap up. That class included, instead of this is the Bears, right? The Bears, which they haven't been a high probability pick since about 1985. Yeah, I'm talking about the football team, right? The Black Swan. What does the Black Swan have to do with this? Black Swan effectively means like it's a really low probability shot, right? You know, you don't necessarily see black swans very often, yada, yada, yada. But here's the fun part. I did a slide deck with the buy me a low probability years ago. And instead of having the Bears logo in here, I had the Cubs logo in here, right? Because the Cubs haven't done anything. The year that I did that, they won. They won it all. They won the World Series. Talk about buying a low probability. So, hey, don't look at this as being a negative, you Bears fans, okay? Look at this as, hey, he put it in the slide deck. Now the Bears actually have a chance. Let me tell you something. They don't have a chance. All right. So when you talk about buying options, oh, and then by the way, we have our Canadians in here, and the Canadians are like, wait a second. Wait a second. We don't even know what football is. It's not hockey. Okay. It's football. All right. Onward and upward. Probability and buying options. Yes, I did. I put a Bears logo in there. It was required. Probability and buying options. When buying options, okay, the probability of making 1 penny or more is, statistically speaking, 50% or less, right? So I'm going to show you just this in a moment. If your designated brokerage technology does not offer probability of expiring, you can actually use delta in lieu of probability in the money. We're going to review a few examples right now. So I just want to review briefly about probability, okay, of making money. All right. In this particular case, okay, and great. I found my first typo in here. I did. If in this particular case, if we take a look, all right, at the I'm going to find this. We take a look at this particular slide number 22. All right, I'm going to fix this. This should say the 51 calls. I do apologize there for the 51 calls. What's the approximate probability of making 1 penny or more? So in this screenshot here, what we have is delta and probability in the money. All right, so delta can be used to substitute for probability in the money. So here's delta, here's probability, what we term in the money. When something says 59% probability, and I want to be clear about this, it doesn't mean that there's a 59% chance of making money, right? There's only a 59% chance that an option even falls in the money. That's the important point over here. So a 51 call gives you the right to buy the stock at what? Okay, if you go out and buy a 51 call, it gives you the right to buy the stock at 51. But the stock right now is trading, for example, at 52. Okay, this option's already, in the money. But what's really difficult for people to comprehend when you're looking at probabilities, okay? Look, when buying options, the probability of making, 1 penny or more is always going to be 50% or less. Now, the reason I went back to that for a second, I got to hammer this concept home. It seems like so minute maybe, but it's critical that people don't get this, okay? It's critical to your longer term success. Look, I know that the probability down below, right here, I know it says 59%, but again, that's not your probability of making money. Okay? If you buy the 51 strike call, it's basically trading for $2. $2. Look, here's the 51 call. There it is. It's trading for just about $2. You don't need the stock at 51. You need the stock at 51 plus the $2, which is roughly what? 53. Okay? Therefore, the approximate probability, okay, of you even breaking even is right here. It's about 36.73. Okay? The way you should think of this, the way that I think of this, if you go out and buy this option, okay, you have about a 36.7% chance of getting your money back. How does that grab you? If you know, people teach like you should just go out instead of trading stock, you should buy a call. Okay? Yeah, but if you buy this call, they don't tell you like, hey, you're getting yourself into a trade that has a 36% chance of getting your money back. Why would you want to do that? Why? How? Why? And if you want more examples, listen, we can go right onto the live trading application. Here's Apple. You ever heard of it before? It's Apple. Okay? We open up the 20-day options. Look, 20-day options. And right here, okay, these are what they call information layouts. Yes, this is Thinkorswim, but you could do this. You could do it on E-Trade. You could do it on Tasty. You could do it on any of the brokerage platforms. Come down to options, theoreticals, and Greeks. There's one for Delta. Here's the other one. It's probability in the money. I just want to show you. Look, I can buy an option. I can buy an option that's like deep in the money. Look at this. That's the 205s. The 205 calls. Do you realize that this underlying is trading at almost 220? I'm buying the 205 calls. And immediately everybody goes, look at that. He got an 80% chance. No, I don't. I have an 80% chance that this option is going to be in the money. Okay? My break-even point is 205 plus $15, which is what? 220. So what's my real probability in the trade? I have about a 45% chance, okay, of making 1 penny or more. Everybody got that? Everybody got that. Because I can go through example after example after example. You cannot show me an example. It's impossible in options that buying a single option has a greater than 50% probability of making 1 penny or more. And if you look and you do find it, okay, you're missing something. There's probably like a dividend or something payable. That's all I'm saying. Okay? Now, let's talk about the put-call relationship. Okay? Again, there's a method to the madness. You need to know this stuff, okay, to have not just success in in-out spreads. You need to know this stuff to have success in this business. Okay? Here's the part that really blows a lot of people, that blows their minds, okay? And there's 2 slides involved in this, and again, this is like the best class to teach this in, because this is the one where, you know, we spend so much time, like, again, evaluating direction. What does the MACD say? What does the Fibonacci say? What does the Elliott wave say? And at the exact same time, people pay very little attention to what the option pricing says. I like to look a lot at option pricing. Why? Am I an options geek? Maybe, okay? But the reason I like to look to some, again, I put a lot of stock, if you will, okay? No pun intended. I put a lot of stock, if you will, into the pricing of options. And the reason is, take a look. Look, this stock is trading pretty much right smack at 52. Have you noticed the price, the 52 calls, is identical to the price of the 52 puts? Look. That option's for 60 cents. That option's for 60 cents. I mean, basically. I took a screenshot right when Intel was at like 52. The stars had aligned. Did you ever ask yourself, why is the call priced the same as the put? Have you asked yourself that? You go, oh, yeah, it is kind of an interesting question you pose there, Don. Why is the price of the call the same as the price of the put? Oh, I have an answer. Because billions of dollars say that nobody knows nothing. Huh? That's a pretty good one. Look, that's what it means. It means 50-50 chance. Okay? If the stock's trading at 52, the 52 calls and the 52 puts should have approximately a 50% chance of falling in the money by 1 penny or more come expiration. Now, this is not me bashing charts. Okay? This is me simply saying that, okay, if somebody knows something, because everybody like assumes, you know, those guys at Goldman Sachs, okay, they got some machine, and I know it. I'm not sure how, but somehow, some way, they're screwing me. Okay, they don't know nothing, because if they knew something, do you think the calls would be priced the same as the puts? Okay, like if they knew this stock was going up or if they knew this stock was going down, come on, the calls would be bid or the puts would be bid. What that basically means is the price of the calls and the puts wouldn't be identical if somebody knew something. And it's pretty evident when looking at option chains like, hey, listen, they price everything fairly, everything cleanly. Go look at some option chains. Like, I mean, it's uncanny how accurate pricing has become today. Yeah, I have Apple up here. I don't care what stock you want to put up here. Like, look, here's Google. Okay, there's this whole Google thing. If you take a look at Google, or you take a look I just want to find an underlying. Goldman Sachs. There it is, Goldman Sachs. It couldn't be any better for my example. If you take a look at Goldman Sachs, okay, and just hang with me over here. Goldman Sachs is trading roughly 220. The 220 calls and the 220 puts. Do you notice anything about them? Okay, look at the 220 calls. They're trading basically 260. What are the 220 puts trading for? 260. This is the greatest example because I was just ripping on Goldman Sachs a second ago, saying that they don't know squat. Not only don't they know anything, okay, but look, the pricing in their options chain clearly says they don't know anything. But then we spend a lot of time over here trying to assess something. All I'm saying is that option pricing is very efficient on both sides of the marketplace. Right? Good? Fun? Okay. Now, once in a while, you will see something that you're like, no, Don, the calls are priced way over the puts, or vice versa. There'll be something, that's hard to borrow, and the puts will be priced way over the calls. If you ever see something, and I want to reiterate this to you, if you ever see something in this business that looks outright wrong, listen to me carefully. Do not trade it. Email me. Okay? Email us. Like, get us in the chat room. Don't think that you're like, I'm going to keep it a secret from Don. You're not keeping a secret. You are going to make a horrible, horrible mistake. Okay? There's a program that runs on the back end of this software. This is Thinkorswim. It runs on the back end of almost every major brokerage software and every market making software. And the actual thing, it's called ARB Free. That's the technology. And what ARB Free does is it looks for anything that could be, like anything that could be mispriced. Okay? And I think that that's a horrible term, because if you look at something like Beyond Meat, you think it's mispriced. It's not in any way, shape, or form, a mispricing. It has to do with the ability to borrow stock, And again, I will reiterate, do not trade something that you think is mispriced, because all of the systems would see it instantaneously. And I just wanted to let you guys know that, all right? It's a pretty efficient market these days. Now we're going to have some fun. Probability of being stopped out. Again, all we're doing right now in these first, 30 or some odd slides is we're trying to give you some background knowledge. Little chunks, right? We talked a little bit about theta, and we talked a little bit about vega. Then we're talking a little bit about probability so that you understand that the world is kind of an even 50-50. I like that. I like it. But we also have to give you a little bit of background knowledge on the probability of being stopped out. And this is something I talk about quite extensively, here at TheoTrade, because there are some easy, I would call kind of like layup things that you can do in your trading. People, regardless of strategy, but there's some easy things that you can do in your trading to circumnavigate being stopped out of a trade. All you have to do is understand a little background knowledge of probability of touching. And listen, when people put on stop orders, and come on, admitting it's the first step. Now, I know that some of you guys might be watching this on a recording 2 years from now. It's okay. This is the part where you want to stop and think to yourself, have you ever done a stop order before? Intraday or otherwise. Have you ever used a stop order before? And I promise at this point, I will not chastise anybody for having used a stop order. Okay? All I will tell you, though, is that when people learn about stop orders, they never learn about the probability of hitting the stop. Okay? The probability of hitting the stop. And that is a scary concept. You know, for years I've been really just anti-stops, but I've actually come to the conclusion now, like, all right, let's not be anti-stops. I'm okay with stops. I am. As long as you know what your probability of hitting that stop is. We're going to call that probability of touching. And this is where people don't ever really look at trading quite the same after you've seen this example. So, all right, the probability of touching. Again, we put the definitions in here. Why do we put the definitions in here? Okay, because we have engineers, people. They're engineers. If you guys have no idea why I pick on engineers, it's because they send me emails that at first glance, you would think it was like a thesis that they've put together. Okay, all I ask is that every engineer that is joining us in TheoTrade, keep it to 4 sentences or less. That's all I ask. By the way, they can't be run-on sentences. I know. Every Canadian engineer is like, that's okay. I can put a lot of ands, buts, and howevers in there. Well, take out your and, take out your but, and take out your however, and give me 4 sentences, people, if you have a question for me. And I will stop picking on the Canadian engineers and engineers in general. Okay? Engineers making the world a more screwed up place one day at a time. Probability of touching. The probability of an individual option strike being touched or surpassed any time between now and expiration. So we talked about probability of expiring. You know what probability of expiring is? It's the probability, okay, by an expiration. It's a probability by an expiration. So I'm going to pull up a trading application at this point, and I want to differentiate for just a moment, okay? We're going to go back to our marquee is always kind of like Apple. It's okay. Apple's something we trade a lot, right? You go some 34 days out in Apple, okay? And you look at these probabilities right here. And this says 22%, but that's a 22% chance, okay, of this strike, the 230 strike, being in the money, okay, by expiration. Expiration is what? 34 days from now. Now, I want to get this right, okay? Listen, what this little probability in the money says, you have a 22% chance of this option being in the money. Basically says this, you have a 22% chance of the stock being above 230 34 days from now. Done. That's the definition for probability in the money. That's actually considered a probability of expiring. Then, we have what's termed probability of touching. Now, probability of touching, okay? Probability of touching is the probability that we touch, and I'm flashing on this, it's 45%. There's a 45% chance anytime in the next 34 days that we touch or exceed the 230 level. So it doesn't there's probability of expiring, which is 34 days from now, and then there's what we term the anytime probability, and that's a 45%. Does that make sense? There's no directional bias to this. The calculations to solve for probability of touching, they're just from the option volatility. The reason that probability of touching is so, imperative to understand, it is really imperative to understand, is that if you purchase a stock at 60, you set a stop order at 59, you set your target price at 62. Listen, okay, here's the bottom line. There's a way higher probability of hitting the stop order than your target price. Way higher probability of hitting the stop order versus the target price, especially when it comes to what? Probability of touching. What's the probability in the next 29 days of being stopped out versus hitting your target price? Well, you can answer that. Here is the example that I set up. This is the XLE. That's the energy sector. Now, by the way, I put a symbol in here like XLE, and I did this intentionally because I don't want you to believe like everything has to be Apple or everything has to be the spiders or everything has to be this. Mix it up a little bit. The XLE is a really, really liquid product, and there's no reason that we should circumnavigate. Like, it doesn't really matter what the point I'm making. It doesn't really matter what symbol is in here. It just doesn't matter, okay? Because it is what it is. In the end, all right, the math behind trading is more important than the symbol you trade. In the end, like, what is XLE? I don't know. It's 3 letters and a volatility. Like, who cares? It's the energy sector. It is so important. Is it? Is it really? Because I look at it as 3 letters and there's a number and a couple other numbers on the screen. I'm very disassociated with what I trade. Unless, of course, it's Tesla, in which case you're like, oh, Elon Musk. All right. So here, this is any time in the next 25 days. What's the chance of hitting, 59, okay, versus the chance of hitting, for instance, 62? That's it. That's all I want to know. Okay, here's the answer. There's a 78% chance of touching the 59 level versus a 43% chance of touching the 62 level. So listen, in the aforementioned example, this basically, okay, that example, all I'm telling you is there's almost twice the opportunity to hit the stop order because you put your stop at 59. So what I'm doing in this case is I'm using options, okay? I'm using options to dictate the probability of you getting stopped out, okay? Does that make sense as well? Now, this probability of touching, let's not take it out of context. There are literally 100 different uses in this business for probability of touching. You could use this to calculate the probability of touching your stop order. You could use this to calculate the probability of hitting your profit target. You could use this to calculate the probability. I mean, I could sit here all day and go through, a checklist of what you could use the probability of touching for. The reason we're describing it in here is because the design of the in-out spread, okay, uses the logic of the probability of touch. The design of the trade that you're about to embark upon uses the probability of touch. Stops. We don't need no stinking stops. Spreads define your risks. Why, okay, would we place a stop order on a trade with defined risk? So this is something else that's going to come up a little bit later. And what it is we're going to use an options spread, okay? And an option spread defines your risk. And then people always ask me the question, okay? This is not just engineers. A lot of people ask the question, okay? I'm not just picking on engineers right now. I'm not picking on Bears or Cubs fans, okay? Yeah, what? You didn't think I was going to bring up the Bears thing again, did you? Picking on everybody. Equal opportunity here. People always ask me the question. We're going to go out a little bit later, okay? And we're going to buy a spread. We're actually going to go buy, okay, a spread trade. And that spread has risk of $1. Okay. Or let's get crazy. That spread may have risk of $5. And then they turn around and they say, can I use a stop order on that $5? And I say to you, well, you could, but why would you want to? Because if a spread defines our risk to $5, or a spread defines our risk, for example, to $1, why would you find it, okay, plausible to need to further define your risk on an already defined risk trade? Do you not see where I'm going with this? You go, I don't want to lose $5. Oh, see, the root cause, right, is about allocation. One of the things you got to take away from this course, this is not just about in-out spreads. This is about account growth. It's about allocation. Okay? It's again, kind of a multifaceted course that we're going through today. And one of the things that I hammer you on is that if you are asking me the question that you need to use a stop, like if you're asking a question about a stop order and like the answer, okay, isn't found in the stop order. The answer is actually found in the fact that you're allocating too freaking large. Like, think about it. Because if you were like, yeah, I'm totally comfortable losing $5. You go, but maybe you're not comfortable losing $5. Maybe then you should only allocate $2. Got to allocate what you're comfortable with, not what you're going to need a stop order on. That's one of the points that I have to hammer that right now, cut you off turn, because you're going to ask it later anyway. So entering into a defined risk trade alleviates the need for stop orders. If you're considering a stop order, don't do it, at least with spreads. Trade less contract size and be comfortable with your risk. Now, spread basics. Finally, we're starting to get somewhere, people. Future success is largely based on the ability to create strategies that transcend market conditions. We often talk about like different market conditions. I'm in a bull market. I'm in a bear market. I'm in a pig market. I don't know. I like to just come up with more and more animals in here. It's a gorilla market. You got to look at those success in this business. We're going to go for some small wins. And that's really, it's going to break down. The in-out spread is a strategy to designed to build consistency, designed to offset a lot of the risks that really hurt people in this business. So think of it as small wins. Okay, let's get our spread on. We're going to consider define risk verticals. Okay, when we want to take directional bias in an underlying. I use the word directional bias. What does that mean? It means, okay, bullish or bearish. Now, I just want to define this because we're going to talk about directional bias, okay, bullish or bearish. So directional bias means bullish or bearish. If you're bullish or bearish, the in-out spread will provide you a strong risk reward without exposing you to time decay, volatility, or the threat of being stopped out. Now, one of the things that this course today is not going to spend a huge amount of time on it, and don't think that I'm ever leaving you hanging, because we never leave anybody hanging here. I'm not going to talk extensively about bias today. I'm not going to talk a lot about, this course today. I'm not going to pull up a lot of charts. I'm not going to pull up a lot of MACDs and Fibonacci's. I will have a section today that discusses, okay, kind of like a quintessential setup that I use. But, okay, we have numerous other courses here at TheoTrade that everybody, okay, is welcome to take a gander at, that are going to cover more of the technical aspects of it, technical analysis aspects, okay, because I have been called an anti-chartite. So if you're bullish or bearish, again, we want to just cut those risks down. Spread structure. We will build, okay, the vertical spreads with a risk one to make one scenario. Okay. Whoa. This is like my favorite thing to explain in here. Yes, we can do trades offering higher probability and higher risk reward. Okay. But when we want to be directionally biased, we want strong rewards with the least amount, okay, of risk. In-out spreads will provide the equilibrium that we seek in our trading. We okay? Everybody good? All right. Onward and upward. In-out spreads explained. Dun, dun, dun. So I'm just going to go through kind of a quick example here. I'm going to pop an in-out spread in here and see if everybody's on par. So this is something that again, this is the painful, the inevitable part. But for those of you that understand these spreads, bear with me here for a moment. For those of you that are brand new, hey, grab the tactics. Okay, right? So we are going to embark upon a stock trade here. Delete that out. And it doesn't matter what that stock happens to be. I mean, it could be a $3,000 stock, it could be an index. It just doesn't matter. In this particular case, I always like to use something like Marquee. So we'll just go in here and we'll use a stock, right? And that stock happens to be trading for, let's say, $200. So it's a $200 stock, right? I do not own the stock. I have nothing to do with the stock, but the stock is trading at 200. We're going to go out and we're going to surround that 200 level. I mean, there's a reason they call this in-out spreads. One strike in the money, one strike out of the money, one strike in the money, one strike out of the money. What's a strike? Okay. Well, strike price is this. If the stock is 200, okay, if the stock is right there at 200, one strike in the money would denote this. If this was a bullish trade, for instance, this would be like the 199 call, and then one strike out of the money would be something like a 201 call. Okay, one strike in the money, one strike out of the money. That's assuming it has dollar strikes. But, okay, I take you into this example because I want you to understand, again, the context of why we build the trade, of how we build the trade. So as I kind of dig into this a little bit, and we're going to do just that, now we're going to start to bridge into, again, very, very specific examples. So let's go out, okay, and let's actually construct this particular trade. So we're going to buy, in this case, we'll call it a 199 call. And the 199 call, that thing is going to be trading for a whopping, we'll call it $3. So buy a 199 call. So what do? Take it down here. We're going to buy a 199 call, buy a 199 call. It's trading for $3. Simultaneously, okay, we're going to sell a 201 call. Now, in this particular class, I can't make this class just about the absolute of spread basics, okay? But in this one, we turn around and sell the 201 call. We collect $2. Net, what are we into this thing for? It's $1. Now, this is a dollar debit. So, that is your in-out spread. Why do we call it in-out spread? Again, stock's right here. The stock's trading at 200. I don't own the stock. One strike in the money, one strike out of the money. The reason you use one strike in the money, one strike out of the money, because it offsets, okay? It'll offset the theta risk. It'll offset the vega risk. You will learn that here momentarily. It also provides an extraordinarily high probability, okay, of hitting your target price. We'll also explain that. What I want to get to in this point is that you understand the structure. Buying the 199 call gives you the right to buy the stock at 199. Selling a 201 call gives somebody the right to take stock from you at 201. When you have, okay, a spread, you have to know what's the most money that you can make in a spread, okay? And the most money you can make in a spread is the difference between strikes, which in this case is $2, okay? So it's a $2 wide spread. This is what we term a $2 wide spread, of which you paid $1. So how much can you actually, what? Well, you pay $1. What can you make? $1. Now, a lot of people look at this and go, I don't like it. I don't like it. I don't want to risk one to be able to make one. Risk one to make one. That doesn't sound good at all. Everything I've ever learned in this business. And they start going crazy when they see risk one to make one. Calm down. Calm down there, cowboy. Let's just worry about structure right now. Okay? By the way, I always start with a $2 wide spread. Why do I always start with a $2 wide spread? Small account, easy, clean. Okay? You could do this in a $2,000 account, $5,000 account. For those of you, if you want to scale up, don't you worry. Okay? When I say scale up, you're coming in here and you're listening right now. You're like, that's awesome, but I have a $3 million account. It's a good problem to have. Don't worry, we scale. Okay? The easiest thing to do is scale the trade up. The hardest thing to do is to get money back that you shouldn't have lost when you're learning to scale up, right? Hopefully that makes sense. But getting this thing to scale, $2, like literally if you did one contract of this trade, you have $100 at risk. Ready? Next. Now we take you into a real example, setting up an in-out spread. Okay? In this particular case, now we're going to get down to it. So here is the XLE again. And again, I don't care that it's the XLE, and I like to always make that point. It doesn't matter what it is, right? It's a $60 stock, and a $60 stock, okay, or index, or ETF, blah, 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 okay? We're going to buy the 59s and sell the 61s. Buy the 59s, sell the 61s. Why? Oh, I don't know, because it's done for like $1 debit. Okay, done for $1 debit. Done. That's it. That's what we have to know at this point. Buy one strike in the money, sell one strike out of the money. Now, that is not criteria. I want to make that abundantly clear. This is not what I construe as criteria. Criteria is going to get very specific. When I say criteria, we're actually going to start in just a few minutes here going through steps. Okay? It's not a 12-step program, but it's not far off. We're actually going to take you through steps. Right now, all we're trying to do is take you through big, broad strokes, if you will, of setting up the trade. Logic, design. When I say design, it's like how the trade is actually designed. So you got to understand one strike in the money, one strike out of the money. It's not going to deviate for that. And when you have a $2 wide spread, you know what you should also know by now? By about a $2 wide spread, usually it's going to be trading for about $1. About $1, $1. Next. Okay. Just say no to risk. Offsetting, vega, and theta is an important component of in-out spreads. You're like, okay, where's he going with this? Well, in-out spreads offset your risks. In-out vertical spreads offset risk. Time decay, volatility exposure, okay, and initial capital outlay are all controlled via using this particular vertical spread. Now, for those of you that have never heard this terminology before, look, the stock right now is trading like at 60. It's trading at 60, okay? And the 59.61 call debit spread, that's what this is. This is a call debit spread, is trading for $1 debit, okay? Now, okay, this should say, and I do apologize, this should say the 60 calls are intrinsically worth $1. Okay, so, and I apologize, that shouldn't say 60, it should say 59. See, this is what happens. No matter how many times I do this, okay, I'll always have a few mistakes. The 59, by the way, there's a lot of slides in here. The 59, okay, calls, those 59 calls. What's a 59 call worth? Minimum when the stock is trading at 60. What's a 59 call worth minimum when the stock is trading at 60? Okay? Yeah, call me Flounder. Call me Flounder. All right? There's a lot of screenshots in here. It's, by the way, these little screenshots, they take days of screenshots to do. It's horrible. Okay? What's a 59 call worth minimum? 59 call worth minimum. Okay, when the stock is trading at 60, it's going to be worth at least $1. And you notice that this trade is going for $1, so that the trade itself, doesn't cost you anything for what we term time decay. That's a big component of the spread. Let me show you a little bit more. Okay, offsetting risks. Okay, the risks that hammer people in this business, just hammer people in this business. One of them is theta. This is what? It's time decay. I told you there was a method to the madness of me talking about theta earlier. See, what we're doing in an in-out spread is we're buying this little monkey here. See, buying that little monkey there and selling this little monkey here. What are we really doing? We're buying with one hand and selling with another. Just like, to me, like, you got to kind of visualize this a little bit. By buying one option and selling another option, it's an offset. Like, it's a complete offset. And all of a sudden, theta doesn't even matter. And you know what we're doing with volatility? Okay? With one hand, we're buying it. With the other hand, we're selling it. Look, it says buy, it says sell. So we're buying Vega. So we have Vega risk right there, and then we're selling Vega risk. So why do we go one strike in the money and one strike out of the money? Because the way that these risks work, okay, this is where the stock is trading. That's a $100 stock. That's where the stock is trading. If we buy here and sell here, okay, it negates the risk on the curve. That's the idea. And that's what people don't get. Okay? They go, I don't like the spread. You should, because it just offset your risk here and offset your risk there. Okay? If we buy the 59 calls, sell the 61 calls, okay, therefore we're buying theta and Vega in the 59 calls and selling theta and Vega in the 61 calls. The in-out spreads, okay, one strike in the money, one strike out of the money, offset those risks, at least in the initial onset. We okay? Are we okay? Everybody good? All right. Because now we're having fun. All right, next. Risk graphs. Okay? Risk, see if I can get it out. Risk graphs on option trades often blur the lines between theoretical profits and the reality of profitability. If you're viewing risk graphs, attempt not to view the trade at expiration. Rather, you can often view trades at multiple points between now and expiration. So again, okay, when you're starting to look at these spreads, now we've covered, it feels like piecemeal, right? We've covered a little bit about theta, then we covered a little bit about volatility, then we talked about probability, then we talked about your stop orders and probability of touching. Okay, now we actually built the in-out spread, the construct of the in-out spread. Now all of a sudden this guy's talking about risk graphs. Again, there is a method to the madness here. This is all, if you will, a little background knowledge to get you more solid when we actually start building the criteria and going through the checklist on the trade. This is risk graphs example. Okay, when people get involved in options, one of the things I have to sometimes do here at TheoTrade is to undo some of the damage that has been done to you by years of looking at things like risk graphs and being taught this stuff in a way that I don't find is useful at all. One of those comes by way of the risk graph. When people look at options trades, Okay, they often look at what we call right here, that hard line. That was terrible, me trying to draw on that hard line. It was hideous. It was hideous. Okay, this hard line right there, that's better. Huh? Okay, one of those. That ain't reality. Okay, at least it's not your reality, because traders living in the real world, you got to look at profit and loss graphs in the here and now, not at expiration. This is what we term at expiration risk graph. This, the softer line, yeah, that baby's real. Okay, so the following risk graph it's a bullish. It's the spread that we've been looking at in the XLA. It's a bullish, in-out spread. The expiration graph, okay, may not be reality for profit and loss, as we rarely intend to hold these trades to expiration. I'm just letting you know now. You ain't holding these trades to expiration. So why do you look at the expiration risk graph? And people love risk graphs. They're like, it's an iron condor. Okay, it's a butterfly. You want to see an iron condor? Oh, I'll draw you an iron condor. Iron condor is one of these. Okay, you go, it's a butterfly. Oh, a butterfly. Oh, it's very exciting. It's a mambo combo. Oh. It's a, who cares what it is? Okay, it's all the same crap, and it's at expiration, and expiration doesn't matter. Okay, because at expiration, you're dead. Listen, you're dead at expiration. Whether it's in the money or out of the money, you shouldn't be holding crap to expiration. That's the point that I'm trying to make. Right? Expiration, is that when you have one foot in the grave? No, that's pretty much when they start throwing dirt on top of you. Now, don't do that. Don't look at the stuff on expiration. Okay, I feel better now. Are we much better? Now we learn to do what's called day stepping. Day stepping. Now, this is a feature, okay, that is not available like in every trading application, but day stepping risk graphs, what it basically does is it allows you, okay, to set multiple points. Like, look, this trade, apparently I took the screenshot on September 9th. All new screenshots. I took this screenshot on September 9th, okay, of 2019. So people from the future, if you were watching this in 2025, I was alive in 2019, okay? There was this, thing called the Fed in 2019. That'll be gone in 2025. Anyway, the risk graph, all I've done here is set the risk graph to point, 1, 2, 3, 4, 5 points in time. Those 5 points in time are represented, of course, by these 5 lines, and it shows you how the trade matures over time. Okay? Apparently, the trade matures over time. I will never mature, but the trade, it matures. And it's more realistic to use day stepping. That's all I'm saying in here. Okay? So just be aware of that. Okay. So onward and upward. Risk one to make one. What? You think I wasn't going to go in here? You think I wasn't going to go in here and address that? I know, okay? I know that once again that we have people that are a little bit mathematically inclined in here, but risk one to make one. Do the math. Let's assume that you do 1,000 trades over a period of a year. I love doing that, because we're like, I don't want to do 1,000 trades. I don't know. You could do 100 trades. You could do 50 trades. All I'm trying to get you to is what I term the law of large numbers. Okay. Remember earlier today, what did I talk about? I said, probabilities are law in the marketplace. That was the first slide that we had today. Probabilities are law, because if you do enough trades in this business, you will never overcome the probability laws. You just won't. Okay. It's just, it's a matter of fact. Like, some people are going to be luckier than others, and some people are going to go and use some technicals and get on some hot streaks. Okay. But the way that I teach this is from a purely, I don't want to put luck in here, because it's not that I don't believe in that. I absolutely, listen, I've got some buddies that, could fall, ass backwards into money in every single trade that they've ever done. And it's just ridiculous. Okay. And by the way, if you follow them into their trades, somehow you'll end up losing money. Everybody should have a friend like that, right? Okay. The friend that can't lose money in the marketplace, except if you, of course, follow them. And then they turn around and they go, you took me down with you. You should never do the same trade as me. Come on. Admitting it's the first step. But I look at this very much from a mathematical sense. And I say 1,000 trades in a period of a year. And you just flip a coin to make your trading decisions. theoretically speaking, you'd be right about half the time, right? 50% of the time without any real trading strategy or management. But however, with a risk one to make one scenario and no management, okay, no management, after transaction costs and slippage, which is the bid offer spread, you'll likely take a minimal percentage loss. Okay, what I'm getting at over here is this. Okay, let me get you back to square one. Some of you come in here, and again, everybody comes in here from all walks of life, right? Come in here from all walks of life. Some of you have taken some big hits in the marketplace. At the very onset of the in-out spread, okay, we go out, okay, and risk one to make one. I don't care if you flipped a coin. See, people take large losses in this business, and I always ask, well, why the hell are you doing that? If I just got you to a point where you could risk a buck to be able to make a buck, you do realize that you would be better off in some of the crap that people get involved in, right? They get involved in all kinds of stuff because in a risk one to make one scenario, if you are right more than you are wrong, you make money. How do you know that? Because I'm giving you a risk one to make one the 50%. The 50% chance. If the 50% chance, okay, what'll happen is you make a buck, lose a buck, make a buck, lose a buck, lose a buck, make a buck, make a buck, lose a buck, lose a buck, lose a buck, make a buck, make a buck, make a buck, lose a buck. But then after transaction costs, that's commissions, and bid offer spreads, yeah, it'll take a minimal loss. Is everybody okay with that? I got to break you back down, okay, to the very beginning. Yes? Okay? No? Sometimes never? Sounds good. But that's what you do not want to hear. You know, no one likes to hear about breaking even or taking a mild loss, okay? But I differ. I differ. I need to get you to the point, all right, in which you will not take and are not exposed to large losses. You got to get back to that point. Do we even know where that point is, people? Individualized trades, okay, are just minuscule pieces of a much larger probability puzzle termed the markets, okay? What we have to get you to initially is this, making you consistent. Now, again, people love to do, all kinds of crazy trades. You risk one to make three. Listen, we have a trade here at Theo Trade where you risk a buck to be able to make 10. But the problem with those trades, okay, the problem with those, the risk a buck to make up 10, they don't pay out very often. This in-out spread pays out consistently. It's designed to make you consistent. The risk one to make one idea, at the very least, positions you, okay, to make effective and consistent trades without, okay, inordinate risks, substantial risks in any one underlying. Again, I put up a slide earlier that success is, incremental. It's very small trades. Success is the sum of small efforts. You got to repeat it day in and day out. Risking one to make 10 can work. You can hit an absolute home run with stuff that we teach like infinity spreads and, and stuff like risk twist spreads. Okay. But you have to have a core logic behind that. Okay. You got to have that. So go ahead. Use charts. Okay. Now we're starting to bridge our way to, we're really getting close to getting into the criteria. So I'm a quant. It's just a math geek. And any strategy that I present, it's going to have some mathematical logic, okay, and based on probabilities. But I've come to the realization that not everybody that comes here is a quant, okay? Not everybody comes here and looks at numbers and be like, oh, that makes sense to me, okay? I grew up around quantitative traders. Before that was even a term. They didn't call themselves quants. They called themselves, okay, arbitrageurs. Like they were involved in stuff that people didn't even know was around in like the 1980s. Okay, I'm a quant. You might be a chart geek. I'm willing to accept you. Okay, if you look at charts and follow trade setups, okay, you may be accurate on selecting directional bias over 50% of the time. Anything over 50% accuracy will produce positive expected returns with a risk one to make one logic. That's the second time I've hammered that home. All I'm saying here is this. If you risk one to make one and you're accurate, let's say even 55% of the time, you're actually going to make good money. If you think you could be right 55% of the time, okay? But do not overthink direction, okay? Hang on! Let me overthink this. That was really designed for the engineers, okay? Directional bias just torments traders. Don't overthink your bias, okay? I mean, listen, you're one tweet away from just total chaos anyway. Who the hell cares? You know, one tweet comes out, you're like, holy crap. Okay. Hey, where were your Fibonacci's then, huh? Where were your Fibonacci's when a tweet came out? You're like, and then you start, of course, you know, you blame the administration. Now you're blaming the Chinese and the trade war. It's crazy. We were having one of those weeks. It was 2 weeks ago. Tweets were coming out left and right. Everybody's like, this isn't even fair, man. It was actually earlier this week. We had a couple tweets where we shot up, then shot back down. Okay. People are like, that's it. I'm just throwing the chips in. Okay. Don't overthink it. Ease up. Okay. Think about many of the trades you may have embarked upon in the past. Were you directionally accurate? Or maybe you just bailed out of the trade only to watch the underlying move your intended direction thereafter. So the in-out spread is going to keep you in the game. It's going to keep you in the trade. It's going to keep you in the game longer, keep you in the trade long enough to see degrees of probability. Okay? Degrees, if you will, of profitability. So you're going to hear terms now, probability and profitability, almost used interchangeably, because probability of touching is now revisited. Dun, dun, dun. There was a method to the madness of our earlier discussion on probability of touching. So we're about to create a spread whereby the probability of touching, okay, is higher on the profitability side of the trade rather than loss. So what I'm saying is, if constructed properly, we should hit our profit target prior to our loss exit. Okay. The way to kind of view this is you have this risk one to be able to make one scenario. By the way, I'm going to tell you right now, we're not even trying to make $1 in this thing. We're not even going to try to get close to $1. Okay. What's going to happen first? Are we going to hit up here or are we going to hit down here? What's going to happen first? Well, here's the answer. There's a neat way to think about this. If we come down here, I'm not going to get stopped out, so it's not going to make a difference anyway, right? But if we come up here, I will get out of the trade. Okay? So effectively what I'm saying is, if there's an equal probability of being able to go up versus go down, okay, when you go down, I don't get out, but if we go up, I do get out, okay, you'll see that the profit target has a much higher probability than hitting the loss. Huh? Interesting way to explain it. Okay, the cart and the horse. Don't put the cart before the horse. Picking direction, it's important, okay, for producing positive returns, but strategy, okay, and trade logic, okay, are going to surpass all of that. Can you mathematically solve for your positive expected returns in a trading strategy? Well, today we can and we will. All right. So we're going to go through, by the way, we're going to go through example after example after example of this. Right. Okay. Because now we're going to start to get into the principles of building the trade and, of course, building the trade itself. All right. So here we have trade logic, capital allocation, directional bias. Those are the principles we follow building a trade. All I've done, okay, at this point in the game today, I've laid some groundwork for the trade logic. I've laid some groundwork for allocation. That's it. Trade logic. Okay. What's the trade logic? It's the in-out spread. Why do we do it? Because we risk one. What do we make? One. Okay. Why do we do the trade? Because there's a higher probability of touching the profitability point before losing the dollar. That's it. Okay. That's the principle. Okay. And the trade logic in this. There's a higher probability of hitting the target, okay, before losing the dollar. So in a risk one to make one scenario, okay, risk reward ain't all it's cracked up to be, because risk reward means nothing if you don't have, okay, probabilities behind it. And I'll say that again, risk reward means nothing unless you actually factor in the probabilities behind it. With that, we're going to start to step into in-out vertical spreads entry criteria. This is a perfect time to take a break. It's a perfect time to take a break, and we're going to do so, and we're going to come back in here with part 2. We are, again, just going to start to dive into a little bit of this. And when I say we're going to dive into it here in part 2, we're going to be back in exactly 10 minutes. So I'm going to make this break precisely 10 minutes. Make sure that everybody sees this on the screen. Break back at 10:33 Central Time. I'm going to start playing music again here momentarily. You do not want to miss as we start to get into the criteria, because all we did in this first section, the first 50 slides, all we're doing, is laying tracks that are about to be used and to come into play when you actually start to construct the beast that is the in-out spread. There's so much going on in this spread that you don't really get unless you start to dig into this criteria. Stay tuned. Back here in 10.